Okay, ladies and gentlemen, thanks for joining me this afternoon, taking the time out of your busy weeks to attend the session. Before we get started today, I'd briefly like to explain the context in which I'm presenting. My name is Patrick Munnelly. I'm, as you can see, the head of prop trading at Little Fish FX. Originally a trading analysis and education firm founded by some ex-Barclays guys back in 2012. The business has since developed a reputation for outstanding trader education and wanted to take the business to the next level by funding retail trading talent. I joined the business in 2016 to lead this new focus and personally manage trader development and take responsibility for the prop trading business. I've been trading myself since 2005. I currently manage my own capital and I also have external investors. I haven't always been involved in financial markets. After graduating all the way back in 1998, I entered the world of consulting, specifically executive search. And in 2000, left the comforts of a publicly traded company to co-found a boutique executive search business that experienced some pretty rapid growth through to 2004, when we merged that business with another firm, at which point I cashed in my stake. Finding myself with a lot of time on my hands and some chips to play with, I started to explore my long-term passion for markets. Due to the nature of my previous work, I had a front row seat to the tech boom and bust and watched people gain and lose fortunes in the markets. So with some capital to spare, I started to dabble day trading the S&P 500 market. Like many who first start trading, I caught some very lucky early breaks and started to make some solid and then some significant gains. However, as is often the case, the beginner's luck ran out, and the gains I'd managed to make, I gave back and then some. It was at this point that I decided to stop gambling and get serious about trading, and most importantly, applying myself as a student of risk. It was a period during which I became considerably more self-aware, focusing not just on developing my technical skills, but more importantly, my mental skills. By 2007, I had a solid, extensively back-tested trading strategy underpinned by a rigorous risk management approach. So finally, I had a complete trading and business plan, which I set about executing. Since 2008, I've been consistently profitable on an annual basis, which is really how I measure my performance. I'm not interested in the outcome of individual trades. My interest lies in my trading edge demonstrating its positive edge over an extended series of outcomes. I can tell you that after developing a successful non-markets business and now a successful trading career, that the common thread in success is really patience and discipline. If you're just playing at trading, you can expect to liquidate whatever funds you put into an account. Trading, like any other commercial endeavor, requires a serious commitment and the persistence to take the hits and keep going, the discipline to develop and execute a plan, and the patience to incrementally increase your account over time. If you're looking for a fast buck, forget it. You'll have far more fun at the blackjack tables in Vegas whilst handing over your hard-earned cash. So that's a flavor of where I'm coming from. What I will do now is just briefly explain what I'd like to discuss with you guys today. We're going to start off by looking at what it means to be a trader and unpacking some of the concepts which I think are crucial. Then I'll move on to explain my core approach to analyzing and framing market data. This is an approach I teach to all the traders on the prop team. Then I'll briefly overview some specific strategies that I also teach during the mentoring phase of the trader development. Then finally, I'll break down what we're looking for in potential prop traders and what we offer in return. So what I'd just like to start off with here is just briefly looking at what I see the core challenge of trading to be, and the core challenge of what it means to be a trader. Essentially, what we're looking to do is how to yield positive returns from what is perceived as to be random market data. And the solution for me, I break down into some core ideas. We're looking for a rules-based approach underpinned by risk that's easily repeatable, that will then deliver those returns. But trading in its rawest sense is really pitting your wits against a marketplace that consists of the best and brightest on the planet, competing to carve out an edge that delivers a profitable equity curve to a trading account. So from the outset, it's paramount that you have an unwavering commitment to trading excellence, because only that will allow you to compete on this stage. Anything other than that, and you're playing a game that will ultimately lead just simply to loss and disappointment. To be a trader is a profession unlike most accepted in the general career context. You're not paid for your time or the amount of clients you close. This is a business that requires a stellar will based on some key principles, which will allow you to only enter the market when your trade criteria presents itself, not because the price looks so high that it has to reverse or so low that it must bounce. The market doesn't care what your view or bias is, and those trading purely on that premise will rapidly eliminate their accounts. A rules-based approach to trading is essential to survive and thrive. Being a trader and the act of trading are two independent concepts. It's important to grasp from the outset that cash is a valid position for the professional trader, and that some of the best traders in the game are those who trade most infrequently. Successful traders do not try to make things happen. If the system gives them a signal, they take it. If the system does not give them a signal, then they don't do anything, or commonly referred to as sitting on their hands. The sooner you realize that you can only take what the market is willing to give you, the better off you will be. The market is always moving somewhere, but movement doesn't equal a business opportunity. Analysis and execution are polar opposite experiences for the inexperienced trader. Many new traders focus all their efforts on developing technical skills, as this has the stimulating intellectual appeal, but they forget to nurture the mental skills required to survive and conquer the extremely visceral emotional experience of executing and managing trades. So if we go back to the idea of rules, risk, and repetition equaling returns, how I break that down then is into market and method, money management, and the mind aspect, which underpins repetition. So let's just quickly unpack some of these core concepts. Seeing over believing. Creation of market price occurs through the confrontation between buying and selling decisions. Essentially, the market is a human organism. It is made up of individual decisions, billions of them, which create a continuous and collective data stream, or decisional stream, we could call it. During this constant stream of data or information, there are many times when that data will be favorable to a position you have, and there will often be times when it's unfavorable to a position you hold. To enhance our decision-making process, we must remove our ego and focus on our edge. Ego has no place in trading, and you really need to leave it at the office door every day before you sit down, as it is the ego or your desire to be right which will detract from your decision-making process. It is essential that we come to the market with a neutral mindset, open to opportunity, that we trade the market as it is demonstrated on our screens, not what we think should happen, but what the market is telling us. One of the key skills we need to develop is moving past our bias and learning to read market data objectively. And the best indicator of direction, and drop the notion of being able to pick tops or bottoms simply on gut feel. Probabilities over predictions. The market is always moving, always changing. It has no defined structure and offers high profit and loss opportunities. In a fraction of a second, markets can go from apparent quietness and stability to extreme speed and turbulence. The specific market characteristic is often ignored or underestimated by inexperienced traders. But having to cope with a completely unstructured, fluid, and ever-changing environment is not something that we are used to. It's like being projected into a world without laws, similar to the notion of atoms in quantum mechanics. As human beings, one of our main purposes is to create mental structures for ourselves, which will bring us security and stability. And this is the main problem that traders have when confronting the financial markets. What we are not used to interacting with an environment which is mainly ruled by change and uncertainty. An environment where the mental and decisional processes of all market participants are constantly evolving and changing. A core rule of the market is to accept change and market uncertainties. There is no other way to survive in the financial markets than to accept that they are ruled by ambiguity. And it is fundamental rule precisely because it's obvious, easy to understand from a theoretical point of view, but much more difficult to put into practice. Trading is about the management of probability rather than controlling certainty. On the contrary, understanding that fluctuations depend on mental processes and decisions of all market participants, which can vary depending upon an infinite number of unpredictable factors, this allows us to start eliminating all the mental mechanisms which generate pain from market data. Process over outcome. Accepting change and uncertainty doesn't mean having a confused or insecure mindset or attitude. In the world of trading, control over outcome has to be given up, as does the need to to be right, or the desire at least not to be wrong. In trading, you can do everything right and still have a negative result. A process, a repetitive routine is essential. Your overall approach, including when you trade and where to trade, all the way down to the procedure established for executing a trade, will form the basis for a structured process. Your routine is a safety net which is linked to discipline, which makes you commit to your process every time. If you trade outside of your trading plan, then it will more than likely be the wrong trade, simply a punt you've taken without forethought. And yes, you may get some big wins, but consistently over time, you will not be trading a plan and you will not achieve the financial results you're looking for. Obvious rules like do not chase a trade or always trade with a stop loss to rules you develop over time, but they are created out of principles to regulate the correct conduct when trading. All aspects are important, but rules cannot be broken, as breaking rules will lead to losses, because you know that these are in place to keep you safe from wild market moves, and more importantly, yourself. The rules you adopt will be guides to make consistent results, but you need to be committed to not breaking them or trading outside of your trading plan. At the core of your successful trading performance is your tolerance to the vulnerability of actually just being wrong. That tolerance is defined as the courage to face your misguided beliefs about your power to control and recognition that you will never, ever be able to control the outcome of a trade. Trading and the drawdowns to your trading account only expose the illusion of control. With the illusion of control gone, the vulnerability of being wrong is front and center. It is here where you face the psychological demons and the fears lurking behind the need for control and the need for being right. This is also the point at which successful traders are born. If they listen to their trading account and the results, rather than what they have falsely persuaded themselves to believe. Let's move on to money management, so risk over reward, preservation over profit. To not be able to apply risk and money management principles is most certainly very disadvantageous for the inexperienced trader. To better understand this point, let us first define what risk management and money management are, respectively. By assessing market conditions, risk-reward ratios, probabilities, and the use of stop-loss orders and many others, risk management aims to minimize the losses for every trade. On the other hand, money management focuses on the steps necessary to maximize profit by the use of trailing stops and adjusting our trade size and other strategies. It is imperative that you make your mind up regarding the maximum amount of capital you are willing to place at risk on any given trade. Most professional traders choose to risk 1% or less on any one trade. This is while having a maximum exposure on their net positions of 3 to 5%. If risking 1% or less of your account on a trade over time can't deliver returns to match your financial objectives, you are undercapitalized. Capitalization is the death knell of a robust trading strategy, and this leaves traders reaching and overextending and often getting hit and blowing up what are relatively small accounts. As the famous trader Larry Hite says, you can't win if you don't bet, but you can't bet if you don't have any chips. Right, let's move on to the mind aspect and repetition. Attitude over analysis. The need to be in control or the need to be right is often associated with effective strategies for success that people experience in careers outside of trading. Yet the reality of trading is an ability to maintain positive expectancy even under a potentially extended period of negative feedback from the market. What prohibits people from this are some fairly well characterized emotional responses. So let's start with inadequacy. This response tends to come from traders with a tendency for perfectionism. They must be right, or at least not wrong. If they make a mistake, they take it as a personal reflection of their competency as a human being. Many traders that I've worked with over the years report that their negative self-talk story tells them things like, "You're so stupid, who told you that you could ever be a successful trader?" The attack on an inadequacy of the person, rather than focusing on the realistic competency and standards applied to trading success. To the perfectionist, one mistake proves that they're not good enough. Notice that this is an assumption learned somewhere that is being applied to trading and competency in working with probabilities, not certainty. The problem is that the assumption has been hardwired into the circuitry as belief and truth. Another response is that of worth. In the same way, personal worth is tied almost to net worth. Many traders believe that they have to work hard for their money, and if they don't work hard, they don't deserve to make easy money. Others don't believe they deserve to be making money, making beyond a certain level of money. And every time they go beyond that glass ceiling, they end up self-sabotaging. Another response I've often heard is powerlessness or helplessness. You know, I've actually seen quite experienced traders fall apart while managing a position. They experience a sense of being overwhelmed and then become unglued. This trait is behind many of the alpha type characters blowing up in the heat of trading. Their illusion of power over the outcome is exposed, and the underlying powerlessness is actually then revealed. What they have not learned is the one thing that they do not have power over, even in the midst of uncertainty, is the power to control the mindset that they bring into that moment. It is a new paradigm that traders need to learn to become successful in the act of trading. In a successful trading mindset, you're able to disconnect your sense of adequacy and self-worth from your trading performance. And as you're able to do this, which I teach, by the way, the greater control you have over the emotions related to performance. In short, your authenticity as a human being is not externally dependent upon your ability to trade. Instead, it comes from your very capacity to risk vulnerability as a human being. The absence of pain changes our perception and gives us the possibility to be able to objectively and rationally view the market data. Objective perception is a fundamental in trading, as traders have to recognize market patterns. Therefore, a rational objective mindset will help us develop a rational decision-making model, which is not based on emotions. Acknowledging the fact that markets are unpredictable and accepting trading risk is what makes the difference between a successful and unsuccessful trader. The losses are an inevitable business cost and can actually only precede gain. Grind over grail. The retail trader is bombarded with information, knowledge, and the promise of achieving overnight success that will deliver financial wealth beyond their wildest dreams, or at least in a short space of time. The convention is that trading will set you free, both financially, socially, and professionally. Let's see if there's actually any truth to these claims. There is indeed the occasional tale of glory where a novice trader has bet big and it's paid off. However, let me make something clear. If your trading approach is based on feeling or gut, you may as well flip a coin because your luck will eventually run out. If you rely on that kind of trading, it's tantamount to simply gambling. Therefore, on the whole, it is widely accepted that trading will not instantly set you free. Trading is a fantastic route to providing the freedoms I mentioned. However, as with everything in life, you have to put forth genuine effort. The inspiring aspect about trading is that it provides an equal opportunity vehicle to obtain these freedoms. And with a relatively low barrier to entry, it can afford success to anyone who chooses to become a trader and commits, most importantly, to trading excellence. Having said that, due to the constant barrage of instant success ringing in the ears of retail traders, it's difficult for some to travel the long and often winding path to trading success. You need to change your approach and think of trading as a job that takes time, the correct application of knowledge, practice, and most importantly, patience and discipline. Many traders become obsessed with a trading strategy or the latest indicator. But what is important to remember is that trading is actually more linked to your mindset than it is to the system you trade. A trading strategy is not as important as the mindset you actually apply to it. There is always a chance you'll correctly pick the direction of the market, but without the correct mindset, you will often fail to actually profit from those trades. So let's consider briefly why this may be the case. It is a fact that you need a trading system, and we, however, as a general rule, that it needs to be clear, concise, and does not need to have a whole host of indicators on the screen. The simpler the system that you can align to your personality will form a bedrock for your trading success, which in turn offers you a fallback when things aren't actually going so well. You have to be familiar and comfortable with it and trust it in order to build on it. Simplicity needs to be at the heart of your trading plan, so that it can be easily interpreted and replicated as you put the pieces of the jigsaw together, which is necessary in order to interpret market data. Developing your plan must be a labor of love to survive the endless pitfalls and snakes and ladders demanding practice and research, which ultimately gives a probabilistic edge in the market. Generally, successful traders have found a method which is adapted to their personality and best capabilities. Trading excellence is a grind, it's repetitive, day in, day out, applying your process and framework. Most importantly, more so than really in any other industry, the emphasis is put solely on you. You are what makes or breaks your trading. You need to be focused. This means picking a time of day to trade where you can concentrate 100% on the market with no distractions from family, work, or day-to-day life. Patience and discipline provide the paydays. What is it? What is trading discipline? How do we define it? Most people, when I ask them that question, suggest that it's an ability to be able to consistently execute your trading strategy and to follow your trading rules. And this may also be inclusive of completing trading disciplines such as preparation and evaluation. Let us consider the two keys to successful trading that I mentioned from earlier. Having a trading strategy with a positive edge and a positive expectancy. And two, being able to consistently execute that strategy. In trading, you'll ultimately have to overcome what is likely to be your own biggest challenge. As I've said before, look in the mirror, it's more than likely yourself. Embrace this because it's part of the trading journey. Often speaking to traders, they will at some point tell me of their ill discipline that's brought about challenges in their trading. Some of these traders see themselves as being ill-disciplined and talk at length of their poor discipline. This will in all likelihood merely compound matters, reinforcing their problems with negative self-imaging. It is important to understand that discipline is a general term, an umbrella for a variety of different trading behaviors, and that very few traders have challenges with every one of these behaviors. Indeed, in most cases, it's one or two areas that are major obstacles to moving their trading to the next level. It is useful for us to be aware of the components of discipline and to be able to specifically define our challenges so that we can seek the required methodology to address them. When a car breaks down, it's very rare, if ever, that the whole car fails. It's usually one or two component parts, but some component parts are obviously more important and have a greater impact on overall operation than others. This is the same for us as traders. Isolating our specific challenges will help us target and defeat them, as well as keeping our discipline during difficult times. So when do traders lose their discipline? Well, there are two main drivers, the technical and strategic aspect, and then the mental aspect. So let's look first at the strategic side of things. Not having a clearly defined strategy with an edge is the first typical problem. Having this is a prerequisite to successful, consistent, disciplined trading. Without one, it's actually impossible to see if you're being disciplined or not, as there is no accountability as to whether you followed your plan and stuck to your strategy, not having had one in the first place. Without having clearly defined trading opportunities, you're trading in a more random and haphazard fashion, which will quickly lead, if not there already, to a dangerous ill discipline. Trading a time frame, style, or market that does not match your talent, skills, risk tolerance, or personality is another major problem. If you're trading in a way that is not best suited to you, and particularly if this is a long way off course, then cracks will appear and elements of ill discipline will occur. This isn't a problem with yourself as a trader, but arises simply because you and your strategy are out of sync. For example, someone who is trading a short time frame, but who is a much more analytical and slower thinker and decision maker, may find that they have challenges taking trades with sufficient speed. To make matters worse, they then get frustrated that they missed out on a trade and end up getting in too late and chasing the trade. A loss of confidence in a trading strategy or a lack of understanding of probabilities and statistics is also a hindrance. Sometimes you'll get a run of losing trades for no other reason than the fact you are trading in an environment that contains randomness, and you will not know the distribution of your outcomes to your strategy. Losing streaks are not uncommon or unnatural. If you toss a coin 100 times, you will get at least 4 strings of 4 heads or tails in a row, and potentially you can get 5, 6 or more in a row. When you understand this, coping with a string of losses is easier, and the temptation to try and recklessly recover them is lessened. So let's look at the mental side of things. First of all, with patience. Environmental and external distractions and quiet times in markets, or just plain boredom, is the primary mental challenge. One of the biggest revelations that many new traders experience is that trading actually is not a 100% full-on adrenaline-fueled roller coaster. There are often long periods where not much is happening and the markets are just simply quiet. The danger here is that you get bored and trade just to do something and not because a trading opportunity, as defined by your strategy, has arisen. Ask yourself, are you trading to relieve boredom or to make money? Find other tasks to do while markets are quiet. Reading, research, strategy development, and so on. The emotional and psychological aspects. Anger and frustration following losses or poor trading can be extremely dangerous. The changes that occur to your physiology and psychology when you are angry or frustrated affect your ability to make objective and reasoned decisions. You're greatly at risk of trading emotionally and not objectively. Take time out and wait until you're in a good trading state before re-entering the market. Equally, overconfidence resulting from a string of successes is the flip side risk. Overconfidence is as dangerous a feeling. It will get you involved in markets with bigger positions than might be appropriate. Create awareness of when overconfidence might occur for you, and where necessary, stop trading or consciously manage your positions. An unwillingness to accept losses is another common problem. If you're not willing to take a loss, then you are always likely to run one and to move your stops. Accepting losses and dealing with them effectively is the key to disciplined trading. Taking on too much risk. High risk creates higher stress, and higher stress creates stronger anxiety and worry. All this weighs down badly on your decision-making ability. Excessive positions also carry with them the potential for huge painful losses that no one wants to take. So taking appropriate risk is a key necessity of, as well as a component in, disciplined trading. Greed is another major pitfall. Wanting too much too soon or trying to make every trade a home run are common problems. Again, the key is to assess your strategy. Accept that as traders, we are in and out of the market over a desired time frame. Whilst the market moves both before and after we enter and exit our trades, our aim is to capture profits within the time frame of our system. Fear. This can come in many forms and may lead to you either not entering the market or getting out too late or too early. Fear of loss, fear of missing out, fear of leaving money on the table are just some of the possibilities. Managing trading position size, accepting losses are part of the trading business, and having confidence in your trading strategy and your own trading ability will all help to reduce and ultimately eliminate fear. Likewise, sometimes life outside of trading presents challenges that can have an impact on you. When these conditions arise, your mindset can often be affected, and as a result, your behaviors become less disciplined. A typical example is where a trader is having financial struggles, either in their trading or outside work, and they start to get into desperation mode. Their only goal becomes to make money in any way possible, which immediately moves them away from the discipline of sticking to their strategy. Personality. Some people are by nature not rule-driven, and many live by the rather rebellious axiom that rules are there to be broken. Others may be impulsive, while still others may be sensation seekers who love excitement and high-level risk-taking. In all of these cases, there is a potential challenge to your discipline. So the key issue becomes getting the best match of the trader to a trading style that most accommodates their personality, working with them to make some changes in their natural approach. The second of these is by far the hardest, especially if those poor behaviors are well ingrained. Trading without emotion in reality is actually a fallacy. I know what people say when they, or what they mean when they say this, and it's not that you trade without emotion at all. What they're really trying to articulate is that you want to have no negative emotions, such as the ones we've just discussed: fear, anger, greed, etc. Some states are conducive to peak performance trading, and some are not. Some states hinder optimal trading performance from taking place. Trying to do something when you're not in the right state of mind is like putting your foot on the accelerator in the car when it's not in gear. Loads of revs, but you don't go anywhere. Most people have heard the phrase of being in the flow. This phrase has been made popular by performance psychologists to describe people who are performing at their peak. When people achieve such states, they have accessed an ideal performance state. Getting into your ideal performance state is important because it enables you to fully access your trading talent and to perform at your maximum potential. When I talk to traders I've worked with about when they've traded at their best or when they've had those peak performance moments, they typically describe those or that period with words such as feeling alert, feeling in control of themselves, obviously not in control of the outcome of trades, feeling calm, energized, positive, focused, confident, and their trading almost becomes effortless. So in order to actually trade with patience and discipline, there are certain precautions we can take to predispose us to achieving our goal. We can check in with ourselves as we sit down for the trading session ahead and run almost a personal inventory to see where we're at, both physically and psychologically. Initially, this sounds somewhat over-engineered, but as with all skills, labor is required to form a habit, and habit underpins ultimate success. The principles I've just covered briefly there really form the core of my belief system with respect to what it means to be a trader and what it means to strive for trading excellence. Are there any questions at this stage? Simon, any questions at this stage? Okay, maybe Simon has left already.
Sorry,
okay,
no, apologies, I couldn't find the unmute button. No questions so far, my friend.
Hi, is that Luke?
It is indeed.
Hi, Luke. I thought Simon had left me in the wind here.
No questions so far.
Okay, great stuff. Well, let's move on then. Okay, what I'm going to do now is move on to look at how I frame market data from an analytic perspective. First, I use structure. When I refer to structure, I mean areas of support and resistance on a chart. I use both static and dynamic support and resistance areas, horizontal support and resistance, and I also employ Bollinger Bands to help project potential areas of pause, correction, or reversal. Symmetry. This aspect of my approach relies upon an element of market psychology, whereby market participants have a tendency to respond in a similar fashion given a similar set of circumstances. So you will often find an element of symmetry in major market swings. With respect to sentiment, I use a proprietary indicator to give a sense of the market sentiment. This is, I'll open up the charts in a minute, you'll see this. It's a psych indicator, which helps to track the sentiment of market participants. It also helps to define when sentiment is waning or reversing, and helps to highlight trading opportunities with and against the current market cycle. For the final piece of the puzzle, I rely on price action signals and look for the market to confirm the confluence of structure, symmetry, and sentiment, and we use this to engage the market, predefining our risk and our potential reward, but most importantly, keenly focusing on our risk. Okay, so that gives a flavor of how I'm looking to consistently frame the market. Now let's take a look.
When you're ready, I've got a couple of questions.
Oh, fire away.
Lovely. So first question is from Pep. I need a script for this. Is that possible?
You need a what, sorry?
A script.
Yeah, I can send you my notes.
Lovely. So just give them your email address at the end.
Yeah.
Yeah, lovely.
I have it on a slide at the end.
Ah, wonderful. Second question, how to drive distinction between boredom to fit curve trading?
How do I describe what? Sorry, say that again.
How do you drive distinction between boredom to fit curve trading?
To fit curve trading, I'm not sure what that means. Curve fitting is to do with backtesting. I'm talking about boredom under live market conditions, whereby the markets are just quiet, we're in low volatility periods, and often what you'll find is if someone's sitting in front of a screen all day long, they get fatigued, and once that fatigue kicks in, then that fatigue is often expressed by a desire to start clicking away at the screen, and so they start looking for opportunities to trade which are outside of their trading plan, and these are the ones that often lead to loss and often lead to the major leaks in your equity account. Does that make sense?
That's all the questions. If there's any if there's any further questions, I'll update you.
Great stuff. Okay, let me pull up some charts here and we can look. So first of all, I'm just going to cover off what I mean by market symmetry, because some people, when I reference that, aren't familiar with what I'm talking about. So here we can see in the market, we get a decent swing low. This is sterling dollar on the daily time frame. We get an impulsive move to the upside, and then the inevitable correction. So what I'm doing is I look to measure the first corrective swing in one of these big against that first impulse move off the lows. And then what I'm looking to do is when we get the next major correction, I overlay that swing, looking for the potential for market symmetry. And you can see here we get this next major high, we pull back, and we pull into what is ultimately an equidistant swing. I can demonstrate this a little bit more clearly using this tool. And we overlay it there. And you can see we actually have a price level. You can also see the symmetry in terms of how we respond when we trade down into that low. Cable makes that double bottom type pattern here and then takes off. And then we get another double bottom here and take off. Now, when I talk about price action for getting into the trade, we can see that we retest this low that we formed over here as support. So this is the horizontal support. We're also testing the Bollinger Bands. Now I just have these Bollinger Bands are you know, there's no miracle behind them. It's just the standard Bollinger Band that you get off, you can pick up on any platform. I don't use the midpoint of the Bollinger Bands. I'm looking for a stretch in the markets, which is where the Bollinger Bands are pierced. But again, I'm not just, that's the fact that they pierce the Bollinger Bands in and of itself doesn't characterize a trading opportunity for me. I'm looking for them for other confluence and confirmations. But as we pull back into this symmetrical move, lo and behold, we bounce off there, but then we pull back into a double bottom as we did here, and we get a bullish reversal from these lows. And you know, that from a risk reward perspective, you know, I'd be risking the lows of that candle to get into the market, and then you know, looking to manage the position as it develops. So that's what I mean by market symmetry, just to clarify that. Another useful tool that I use consistently, I've done a couple of presentations on for Round the Clock Trader, is Divergence. And for this, I use the psych indicator. So we can see here with cable that we make this major high, we pull back, put in a double bottom, and correct up into the upper levels of the stretch in terms of the Bollinger Band, pull back, get a nice little bullish reversal here to make it to run up for a test of these prior highs. Now we can see when we test these highs that, let's get this horizontal line, that the market, although looking fairly bullish, is actually starting from a psychological and sentiment perspective. We're not seeing the same type of support that we saw in this move to the high. So here we saw a good run up in terms of the psychological, the psych indicator or the sentiment in the market. But when we retested this high, there was a distinct lack or waning in sentiment. So we have the double top. We're retesting the upper stretch on the Bollinger Band, but we've got a problem with sentiment. And then we get this bearish reversal. So we make a high outside of 2 standard deviations on the Bollinger Bands. We break the highs, but on the day we close back at the lows. And so that would do, you know, again, from a risk reward perspective, it seems like that would be a great opportunity to enter the markets, and you can see price falls away significantly there. What we then have are further opportunities as the downtrend develops, where we can start to see lows being made here, but again we're seeing a waning in this bearish sentiment. And again, as we pierce the Bollinger Band lows, so you know, looking at the stretch in the market action, you can see that there are trading opportunities developing here from these bullish inside bars against that spike low. We get a bullish outside bar here against that spike low. And again, we've still got this waning in bearish sentiment as characterized by that trend there. So again, these breaches of the stretch in the Bollinger Band showing that the market stretched to the downside, a waning in the bearishness from a sentiment perspective gives some pullback opportunities that are tradable. And then when we make this next leg down, it's taking out this channels trend line support down into this low here, we see again a big divergence in sentiment, which once again gives us an opportunity to do something on the long side. Let's take a look at can take a see. I mean, this is a weekly chart of the dollar here, and we can see here that the same strategy or same approach and framing the data works pretty well. Where we're testing into the upper echelons of the Bollinger Band on a weekly scale, but you can see that there is a significant reduction in momentum for this upside move, and then we get some bearish reversals that brings us into a protracted move to the downside. But again, as we pull back and make new lows, sentiment once again is not confirming this low, and this sets up a number of opportunities to get in and do something on the long side. Interestingly, at the moment, this move that we're seeing, this push higher in the dollar, worth watching, over the coming weeks, because at this stage, it doesn't appear that the sentiment in the market is supporting, and we could be running up here on fumes, especially if we retest this this trend line resistance up here, the upper echelons of the stretch in terms of the Bollinger Bands. Any type of bearish reversal up there could be an interesting trading opportunity. Let's see what else we've got. Euro. Just taking you through again. If we just, I mean, I like to. It's just visually so easy for you guys to see in terms of attempts to make highs, new highs, well outside of the upper echelons of the Bollinger Band, and lo and behold, sentiment not supporting, a bearish pin bar reversal, and things take off to the downside. I've marked up a few of these. Let's go through. So again, attempts to make new lows outside the Bollinger Band, holding this support zone, and sentiment is telling us that the market isn't chasing prices lower here, and we're likely to see a reversal, and we do. More upside action here, big bearish reversal from the upper echelons of the stretch in terms of the Bollinger Band, and we get a decent trade to the downside. Something I'm watching here in the euro at the moment, this is, where is this? This is last year, 2018, before we saw the slide to the downside heading into just early summer. You can see every test lower in terms of the range we were trading was supported here with the sentiment indicator. When we broke down though, once the sentiment broke support here, before price broke the structural support, was an indication that sentiment was rapidly changing here, and we were likely to see a sustained push lower as we did. And it's worthwhile looking because we currently have a similar type of scenario developing. We've just broken down here now this week on the sentiment indicator, and we've seen a few pushes lower this week in the euro. A close below this 113 area, might open the door for another run down, like we saw around this time last year. We've been in this pretty frustrating range trade since the back end of last year. A couple of false breaks in here, but sentiment starting to suggest that this thing might be ready to roll over and really flush some weaker hands out of the market. So that's that's worth watching, and would kind of correlate with the idea of the dollar making another thrust higher here, but again falling short once we get up here would be my thought. But again, it's about trading what we see, not what we think. So I'd be looking for confirmation if we do get up here and this euro does let go to the downside of a reversal before looking to do something on the short side. And it's worthwhile noting that we have a similar pattern. I mean, that ascending trend line that I had up there on the dollar would again correlate with the euro down testing this 111 area, and similar to the idea or the notion with the dollar index. What we can look at then is, are we about to test this larger trend line here in momentum, and do we find support? So I mean, this is again, this is a market view and a type of analysis I teach, and the idea of divergence and price action reversals from this dynamic resistance zone is again the strategy I teach, and as with everything I teach, it's underpinned with a real focus on the risk management side of things, and obviously mental aspect. A more simple strategy, almost color-coded this one. This is a pin bar strategy that I also teach, and we've written up some indicators which just make this strategy very straightforward to use. We're only looking to trade pin bars with the perceived current market trend. We have a proprietary tick-based indicator that gives us a reading on trend. So these candles, if I pull up the other sterling chart that I had, doesn't have, you can see here. Yeah, you can see here, you know, this candle is bullish on a plain candlestick chart, but our trend chart tells us that even though they close it higher on the day, underlyingly there is weakness in the market based upon the 5-period moving average of the ticks within the data range, which on this chart is a daily chart, and we get this pin bar signal. Gives us our entry levels, our stops, and 3 levels of take profit, and we ripped through those this week. And if you missed that one, then let's see, show markers next. You can see there was another setup here down to 2 levels of take profit. The trade would be risk-free now. There was a subsequent one. And down to the first level of take profit. On the basis you've had 2 of these already in the week, you probably wouldn't be looking to get in on the third. But equally on the long side, you can see we wait for we're only trading the green pin bars with let's see. Green pin bars with the green candles. So we just scroll over here and just see some more. You can see each pin bar is automatically set up for you. On the close of the candle, you get your trade levels, your entry, your exit, and what you're simply looking for is the red candle with the red arrow. So where we get the red candle, red arrow, we know we've got a trading opportunity. So those are just that's just a brief overview of a couple of the strategies that I teach. And are there any questions on it? I mean, obviously, I would imagine there are questions on those, but they probably won't be. We won't be able to cover those off in this session. But if there are any immediate questions, just let me know. You can fire through an email to me. My email will come up at the end of the presentation. So finally, look, what I want to do just to wrap things up is just briefly discuss what we offer in terms of the prop trading program. One of the core challenges for the retail Forex industry, as I discussed in the presentation, is capitalization. Undercapitalization is the principal driver of ill discipline in the retail trading industry. When traders being forced to overextend themselves to try and make their returns financially meaningful. The core proposition of what we offer at the LFX prop program is, instead of taking a relatively small amount of capital and putting it into an account and trying to turn it into a meaningful sum, we advise you invest that capital in yourself, benefiting from professional mentorship to take your trading to the next level and providing you with the financial firepower to trade with patience and discipline while benefiting financially from those returns. We're offering aspiring traders the opportunity to apply for a place on the prop trading program. As a successful prop trading applicant, you'll be given the opportunity to work closely with me from anywhere around the world. Once you successfully complete your mentoring program, you'll qualify to earn a full-time prop trading position with us, trading our capital at zero personal risk to yourself and on a profit share basis. What's involved? You'll work with me to create a tailored custom lesson plan based on your experience, skill set, and commitments. The program will last from anywhere between 3 months for experienced traders to up to 12 months for inexperienced traders. You should expect to spend about 10 to 20 hours a week, depending upon your experience, studying to succeed on the program. Our Forex trading course has everything you need from a market minute, to take you from market minute to a trading chart. Get everything you need to further your trading education via our comprehensive trading course. This is packed with educational material from trading plans and strategies written by me. And it covers absolutely really everything you'll need to be successful. The course has 24 chapters of comprehensive Forex education, step-by-step downloadable PDF trading plans, 18 trading strategies from beginner to advanced, and videos to underpin these. And you also get access to our proprietary indicators. You will then be involved working weekly on a one-to-one mentoring session. And obviously, like I've said, depending upon your experience, these sessions will either be educational, bring you up to speed with the technical and mental skills that you need to make it as a professional trader, or for the more experienced traders, they'll form the basis of assessing their current trading strategy and making sure it adheres to our performance metrics over a fixed period of time. You'll also have access to 2 weekly team calls where other traders on the team will be sharing their experience and challenges and their market approaches. We also give you access to institutional insights. These are institutional FX research reports and spot desk trading comments from tier 1 interbank dealers, highlighting market context, positioning, and the sentiment of major market participants. These will give guidance as to prices to where institutional players are looking to engage the market. And then finally, from a capital allocation perspective, once you've accepted on the course, you'll be allocated an initial £50,000 of capital to trade your strategy. Like I said, at zero personal financial risk. Furthermore, you'll benefit from the profit share from the profits generated on your account, which will rise ultimately up to 50%, with the ability for you over time to manage up to £200,000. Up to £200,000 in our capital. So that's pretty much really from the prop side what we've got on offer. I understand that there's a lot to digest there. I've been talking for 50 minutes. Are there any questions at this stage?
I've got none at the moment for you. So, excellent. Thank you very much.
No problem at all.
How much is the cost of the program?
That varies depending upon your experience level. If you go to the site, there's information regarding the desk fees, etc.
Excellent. So people can just get in contact with you directly, go to the website and find out a little bit more information.
A little bit more. And then if anyone is genuinely interested, what I like to do is set up an initial chat, a Skype chat with them, where we talk, can find out more about where they're up to and make a call upon, where they're at from an experience perspective. And then we can talk about what's involved from a cost perspective. But ultimately, okay, as I've said, it's making the trade-off between just taking a small amount of money and putting it into a trading account and probably blowing up and losing it, or actually investing it in yourself to then be able to trade a significant amount of money, whereby trading, professionally with the approach I've outlined will actually give you some meaningful financial reward, as opposed to taking 2 or 3 grand and putting it into an account.
Exactly. So you could almost say that it's a tailored package. That's
correct.
Yeah, excellent, fantastic. So if there are no more immediate questions, thank you very much for joining us, Patrick. Have a wonderful weekend.
And you too, Luke. Thank you very much, everyone, for watching, and I'll catch you guys soon.
Lovely. Cheers, Patrick. Take care now.